Welcome to the September 2021 Advanced Projections Economics Report. First, our forecast reviews. In the few weeks since our August report, the Delta variant of the COVID virus has spread rapidly within the unvaccinated population of the USA. It now accounts for 99% of all newly identified U.S. COVID cases. Today, September 13th, about 54% of all Americans, 179 million people, are fully vaccinated, with about two-thirds of those aged 18 plus being in that category. Federal and responsible state administrations have continued to stress slowing down and then eventually eliminating the consequences of COVID through vaccination. COVID vaccine doses remain highly available in very broad and deep distribution nationwide, with at least 75% of the age 18 plus population, about 209 million people, having received at least one dose of vaccine. New cases per 100,000 population have now significantly moved into the youngest half of the American age demographic, those 39 and under. Entrenchment of anti-vax disinformation and politically and ideologically based resistance motivations are slowing vaccination rates down to a relative crawl, even as the national virus death rate has again moved well above 1,500 per day. By the time of our next report, it will have surpassed again 2,000 per day. Please imagine if this new wave, the fifth since COVID first showed up, were instead resulting from war or natural disaster. The social response would be entirely different, we suspect. A large $3.5 trillion multi-year infrastructure restoration and improvement package has been negotiated in a bipartisan manner, and we expect passage of the first $1.2 trillion from the full Congress by the end of September, already approved in the Senate in August by a 69-30 vote. Real estate prices have slowed their growth, with some buyer delay and fatigue being reported in many areas, and that trend is likely to continue through what remains of the year. But low mortgage rates and short housing stock supplies persist. Recent housing start data calls for an annual new home building rate of about 1.5 million units, keeping the pressure on building supplies and their prices. About 3/4 of July's new home sales were for units still under construction or not yet even built, with a mere 10% of the new home supply being fully completed units. Artificially high year-over-year consumer price index comparisons have boosted talk about impacts of expected inflation. However, we point out that inflation from mid-2018 to mid-2020 was nearly flat for 2 years. The Federal Reserve continues to claim we will see only a quick but temporary bump up in prices lasting perhaps 1 year or so. Now, this does not mean that most of those prices will come back down. However, the most volatile ones, food and energy, should return to pre-pandemic levels. We have seen figures confirming the onset of inflation during the second quarter, with the CPI up a little less than 2% in just 3 months, and 5.4% in the year since the economic bottom last summer. At this point, year-over-year inflation appears to be set for a 6% bump in 2021. Generally, the party in equities continued almost unabated, with new index records being recorded throughout August. However, a weak employment report for August seems to have triggered a little more caution in this early part of September. Additionally, margin borrowing by investors after 15 months of continuous growth fell an astonishing and significant 4.3% during July. We will provide more detail later on in this report as to what this may portend for the markets. Over the past 4 months, we have said there was nothing visible on the horizon that would pierce the bubbles in the equities markets, but that great caution was still warranted in taking personally huge positions in markets which are outrageously risky from valuation standpoints. The Fed, The Treasury and the popular financial press have continued to discuss how and when the Fed will begin lifting short-term interest rates above the near current zero. Now, several large investment houses, including Goldman Sachs, have issued warnings about the overpriced equities markets. The current inflation numbers, along with strengthening employment numbers, could induce the Fed to first change their rhetoric, then their actual policies. Unemployment took a big dip down to 5.4% in July as nearly 950,000 jobs were added, but August's number was much weaker, just 25% of that July figure, putting the unemployment rate down now at 5.2%. A couple of months like July would have put us under 5% unemployment, and at that point we would expect to hear a somewhat different tune from the Federal Reserve and some anticipatory bond rate changes as well. One of the Fed governors has already stated that he would vote to wind down Fed asset purchases under such circumstances. Slowing employment will increase the uncertainty about the termination of Fed accommodations. Now some details about the current underlying socioeconomic situation. First, of course, again, is the pandemic. The more highly contagious Delta variant is now effectively posing the entire threat to all the unvaccinated individuals domestically and internationally. In U.S. states with lower vaccination rates, case and fatality totals are again on a rapid increase, and there is definitely a hard race between dangerous variants and vaccinations that has to be won if the COVID pandemic is to be concluded. The CDC had already stated that there is a fresh pandemic amongst the unvaccinated in many areas of the country, with cases increasing at national rates we saw last fall ahead of the very deadly third wave. In this past month, the average daily case rates pushed up from about 100,000 to 150,000. Total U.S. fatalities have reached over 660,000, up approximately 30,000 in just the past month. At the onset of July, the major accomplishment had been to reduce the daily fatality numbers down below 400 per day, entering an area of societal tolerance, shall we say. Now, within September, we have over 9.3 million active cases, with more than 9 in 10 of those amongst the unvaccinated, and we are likely to see fatalities push up past 2,000 per day again, because the fatality rate still sits in the vicinity of 2%. That rate times the active cases suggests another 150,000 to 180,000 fatalities in the near future. This development and the efforts made to control it will be the next significant challenge to the economic recovery, which had been so encouraging just a few weeks ago. Offshore, the situation remains dire in many places. There are large shortages of critical care capacities and vaccines for distribution, attributable to several errors in approach, planning, logistics, as well as manufacturing capacity limitations for equipment and vaccines. Globally, cases have reached 223 million, up 20 million in August. At this moment, there are still about 600,000 new cases being reported daily. Global fatalities have now solidly reached past 4.6 million with a fatality rate of 2.2%. The fifth wave is at work everywhere on the globe. India is now second behind the U.S. in cases and fatalities and still may eventually surpass the USA. Africa, which is significantly undervaccinated, is literally a petri dish for breeding new COVID variants likely to move to other continents. So far, the existing vaccines appear to protect against severe illness from all the known variants, but the Delta variant is more contagious and more harmful amongst the unvaccinated younger folks under age 45, more so than the initial 2020 version of the virus. U.S. health officials are currently claiming evidence that a booster shot is likely to be needed by those at highest risk. It is encouraging to see that the developers are now thinking ahead and anticipating a problem rather than being months behind and having to react in a renewed emergency. Experts are also saying that personal mixing of vaccine dose types is very effective. So between the three major versions available in the USA, boosting with a mix and match approach could be the most likely approach, requiring no new development, but rather just increasing supplies. We are being told to expect a third round of the mRNA booster shots to become a reality by as soon as September 20th, and they would be made available to most all who receive their initial doses in the first quarter of this year. Now, the graphic fatality model that we've been using since it was created on November 20th of last year is shown in our written report. We've been modifying it periodically to show the danger in letting the pandemic continue its havoc here in the U.S. At the beginning of March, we were still running above the original projection in terms of actual fatalities versus the model. So we were waiting to see for another couple of months if the problem was truly being solved by the first vaccine rollouts, as would be evidenced by actual fatalities declining below the model's curve, and then finally flattening to just minor increases. That was confirmed in our July report. Last month, we adjusted our predictive model to incorporate the expected effects of the Delta variant via some new orange boundaries in the right half of the chart. And with 1 month of new data, that model has already reflected its predictive accuracy. Our upper curve is more pessimistic than ones which can be found elsewhere, but the lower bound is about where most other forward-looking models are now to be found. Major models are showing U.S. fatality totals reaching or exceeding 750,000 by December 1st, also clearly above our best-case scenario. We continue to hope for improving domestic acceptance of the vaccines with some rapidly expanding public implementation based on new pleas, incentives, and mandates directed towards those still holding out. Without the vaccines, U.S. fatalities would have exceeded 900,000 by mid-2021, based upon our being above the curve in the chart during the first quarter. So already, nearly 300,000 lives have been saved in a matter of a few months by the vaccines. Those benefits could and should continue to accrue from both our health and economic perspectives. As this unwelcome turn of events by the Delta variant unfolds, it can return us to a pretty unpleasant picture within just another month or two. Now for the rest of the economic environment. In August, unemployment levels moved down to a national level of 5.2%, even after a tepid monthly gain of 235,000 non-farm payroll jobs. However, there are still 8.4 million remaining unemployed persons, many now without the lifeline of extended unemployment benefits. We had been anticipating that return to work gains would flatten out below a full recovery level, but with the removal of many COVID-related restrictions, the pace of job recovery had quickened. This is consistent with our view that job gains will continue to return, but still take 10 to 15 months more to erase most of the remaining 5.4 million job losses created by the pandemic. This still assumes no significant pause in progress here due to a resurgence of COVID cases and associated employment or activity restrictions. In our written report, we have two charts from the U.S. Bureau of Labor Statistics, which have the updated information from the employment reports all the way through the end of August. Some of the country's largest employers are committing to increase wages and benefits to help fill their openings. Several major employers have announced full college tuition assistance, for example. Many large employers are now insisting on a fully vaccinated workforce, including the federal government's executive administrative branch, by far the largest of the three branches of government. A nominal level of 4% unemployment would be a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies, perhaps beginning in mid to late 2022. We expect a decline in employment to below 5% will trigger a change in Federal Reserve rhetoric, signaling that we should expect to see an eventual end to their current accommodative policies and associated near-zero short-term interest rates. In August, equities pricing continued to power ahead with more volatility, setting new index records and pushing deeper into bubble territory. S&P 500 earnings for the second quarter of 21 exceeded estimates for 90% of the companies in that index. Second quarter 21 earnings reports showed year-over-year second quarter earnings for the S&P 500 up well over 40%, which was strong given the circumstances, but it is hardly anywhere near the amount that would have justified the continuing leaps in equities prices over that same one-year period. Worthy of note is the fact that the trailing PE ratio of the S&P 500 has dropped significantly with the final reports of the second quarter earnings, down from the low 40s in July to the mid-30s in the past 2 months. But that is still about double the historical average. The important point is that Wall Street has just shown large improvements over dismal figures from the first 3 quarters of 2020, but those would be far less impressive if the COVID decline had not ever created a significant earnings depression. We have a chart, again, courtesy of FactSet, which contains some illustrative markups in red, putting this kind of mismatch and imbalance in perspective, demonstrating how much of an unrealistic anticipation gap still remains in equities prices in the context of the expectations over the past decade and compared to just before the pandemic took hold of the markets. Somewhat less robust growth is now expected in the second half of 2021, and the projections out into annual earnings for the next year show only an 11% growth in 2022 earnings against the full year 2021. Lower revenue and earnings growth projected by companies themselves serves as a warning to investors that the equities party is likely to come to an end soon. Another FactSet chart shows that almost 50% of the S&P 500 companies have issued negative guidance for the third quarter. Now, if you want a deeper read into this information, we've provided a link to the FactSet document, which is about 10-12 pages, and it's definitely worthy of your review. We've been watching market performance and continuously increasing margin borrowing levels over the past 3 years, as it is our favorite tool for indicating speculative excesses. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. The latest information on margin debt is from July of this year, shown in a fresh chart from Advisor Perspectives. We had expected to see an increase during May, which did materialize at about 1.7%. And we claimed it was likely that June would also show another increase, which came in at 2.6% up. However, in July, margin borrowing delivered a surprise with a drop of 4.3%, erasing the gains of the previous 2 months. This implies that, behind the scenes, margin lenders are tightening requirements in anticipation of a correction, and or smart money is deleveraging with the same kinds of anticipations. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return to warm market levels would take the S&P down to about 3,400 from its current 4,500, and a correction to the mean would be in the 2,700s. We are about due for another such correction, as equities cannot continue to defy the logic of value gravity indefinitely, and several investment banks have now issued such warnings, amongst them Citigroup, Morgan Stanley, and Goldman Sachs. These statements should not be ignored. Now, some trigger for a correction is usually required, such as a downward surprise in corporate earnings, not yet likely, and or many banks reducing their exposure to market excesses through the deleveraging of speculators and margin borrowers. With July's 4.3% drop in margin borrowing, this may have begun. Certainly, the renewed COVID emergency would also fall into the category of a trigger as well. This might take another month or two to develop, considering current situational tolerances and psychological resistances to vaccinations and social restriction changes. However, we repeat our warning projection here now. History also suggests that equities tend to correct 10 to 12 months after the resumption of GDP growth, i.e., when a recession ends. That suggests a potential window for a correction in this September to November 21 timeframe, based upon our November 2020 announcement that the recession of 2020 had ended. Now, our AP individual indicator information comes with the following. August closing value for the S&P 500 keeps our AP stock index indication as red, with that index further up into blatantly overheated territory. One primary indication of the top-heavy nature in equities is the continuously widening spread between the S&P 500 and our metric representation of the GDP. This gap continues to grow, as shown in our third chart. We see this as an indication that more of our money supply is still being directed towards speculative financial activities rather than into solidly productive activities such as the production of goods and services. In our form of what is more widely considered to be the Buffett indicator, the upper smooth curve on the chart is also the boundary between a warm market and a hot bubble zone. And we are deep into that hot bubble zone. Another chart, which we first showed in our March report, is courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. equities markets are using a set of 4 different market indicators, yet very similar to our own in philosophy. The risk indicator average was 176% 2 months ago, last month at 181%, and now at 186%. The risk in equities continues to penetrate new all-time highs. Status of our other indicators outside of the stock markets themselves. The AP money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, having reached an estimated $20.57 trillion, up 25% since the beginning of 2020, but with only a minor upward change in the second quarter of 2021. The rescue and recovery stimuli clearly added further to the money supply earlier in the year, and this was reflected in the final M2 money supply numbers from the second quarter. One item worthy of note is that the velocity of money declined very slightly again during the second quarter, as the increased money supply is still not being spent at anywhere near historically normal rates. Generally declining money velocity has been a fact since the days just before the Great Recession, and the M2 velocity now at 1.12 sits just above its all-time low of 1.103. Set in the middle of last year. This means it now takes nearly 11 months to turn over the money supply once, when it should normally take about 7 to 8 months, implying a normal velocity of at least 1.5. We expected the second quarter 21 velocity to remain flat, which it did, and we now anticipate a small downward change in the third quarter. Recent action in gold prices show a test and rebound from support levels just below $1,730 in August, with prices again hovering around $1,800 per ounce. Silver dropped about $1 from $24.50 to the $23.50 range, and rhodium took another fall down to below $16,000 per ounce and failed to recover much of that by the end of the month. Now, I just checked the figures at the close today, and rhodium was down another gob, about 15% in just one day. Platinum continued to trade between $970 and $1020 per ounce. Month-end prices for gold and rhodium keep our AP precious metals indicator deeply into the red, but that ratio is finally declining per our long-term expectations. The July leading economic indicators from the Conference Board improved solidly, pushing our APLI indicator a bit further into green territory. We continue to expect further improvements to these LEIs during the next few months, barring serious COVID Delta effects. The Conference Board also maintained their improved outlook for economic recovery, and that we should expect a more robust recovery well into the end of the year and into 2022. So our LEI indicator will likely stay solidly green for many months. All of this is, of course, predicated upon the absence of any overwhelming equity market correction or a sudden worsening of unemployment during the upcoming months. Our APYC yield curve indicator continued green, now continuously for 6 months. The yield curve continues moving all on its own, maintaining a more normal shape, with the short end firmly anchored near 0%, but the long end moving up 7 to 10 basis points by the end of August. The Fed still has little room to do anything on its own with short-term interest rates to further stimulate should it become necessary. If inflation pops up harder or longer than they expect, or if a further expansion of the equity bubble becomes worrisome, the Fed may be forced to react, raising short-term rates, which would likely collapse the equity bubble, if it has not already done so under its own weight and imbalance, which is what we believe to be the more likely scenario right now. AP's traditional measures and definitions of recession already indicated a technical end of recession 2020 back in November of 2020. In late July of 2021, the NBER and the Federal Reserve had finally taken official notice of this technical end, despite our own months-old declaration that the recession 2020 had ended approximately 8 months after it began. So you can see in our remarks last month about their rather odd description of the finale to recession 2020. It was a short recession, but not nearly as short as their laughable 2 months as they claim now. We maintain a cautious and very neutral stance here. The economy was coming out of its COVID lethargy as restrictions on business and social activity have been rapidly dropping by the wayside, and the barely noticeable fourth wave of COVID infections had already gone away due to widespread initial vaccination programs. That assumed that was what was going on in the rest of the world, did not push something unpleasant back into the U.S. via the Delta variant. Clearly now, that was being a bit too optimistic. Market and investor anticipations of the ongoing return to normalcy may continue for many months, but increased dynamics and volatility should still be expected, especially if Delta gets increasingly worse, and there are economic ripples from the end of extended unemployment benefits and the end of the eviction moratoriums. So in summary, we reiterate that AP had calculated that the actual onset of a recession had begun in early 2020, a fact which was then confirmed by the NBER in June of that year, and it became officially acknowledged by the Federal Reserve later in the summer of 2020 with their adoption of the NBER declaration within their own data sets. However, as we have frequently noted, the technical end of recession 2020 already occurred by the mid-fourth quarter of that year. 4 of our 6 recession indicators are now in green territory. Precious metals still show red, and the extremely risky equities markets also show red. We are now entering a period in which our 6 standard indicators can be relied upon again, but must still be augmented by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. Because of this real-time status outside the bounds of normalcy, we maintain our next recession potential at 30%. Some final notes. We continue to maintain that this is an extremely risky equity market environment with the potential for significant and protracted drops or flash crash scenarios based upon the disparities shown in our charts over the past several months. A correction of 25 to 35% could very easily happen before the end of 2021. Only those with the highest tolerances for risk and a time-based tolerance for protracted returns to break even should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The only recent moderating influence in this scenario is that the Federal Reserve has continued to state a willingness to maintain its near-zero interest rate environment, and that has continued to fan the fires of market speculation. That situation may persist for up to another year, or we may now expect that some events will arrive to pop this speculative equities bubble in short order. Within the much longer perspective, history may repeat itself in that we could expect to experience another roaring 20s as public confidence, optimism, and spending take over once we can put COVID finally behind us, just as happened 100 years ago when the Spanish flu finally became a non-event. Note that despite the glossy economic reputation of the 1920s, there were 3 recessions in it, even before the big one. The end of those last 3 recessions opened the floodgates for the final speculative excesses that popped in the 1929 market crashes. Well, that's all we have for now. September should certainly be an extremely interesting month from the perspectives of the markets and what happens with the pandemic as well. So we look forward to being able to report to you on some predictions come true and perhaps some good news by the time the beginning of October rolls around. Until then, thanks for listening, and please visit our website and like us on Facebook.